Welcome to this explainer. Today we're completely demystifying money. We're taking a decade's worth of investment banking secrets and distilling them down into a dead simple step-by-step roadmap so you can build your financial pyramid from the absolute ground up. Whether you're currently trying to dig out of debt or you're sitting on a decent chunk of savings, by the time we wrap up, you're going to have the exact blueprint needed to build real, lasting wealth.
Right, let's jump straight in. The most empowering truth about money is actually pretty simple. True financial security is not about being a math genius. You definitely don't need an Ivy League degree for this. It's really just about following a proven system. The top 1% use very specific, repeatable strategies to manage their finances, and honestly, the best part is that those exact same strategies are completely accessible to you right now.
So here is exactly how we'll be building your financial house today. We'll find your baseline, tackle any debt, set up your goals and budgets, figure out exactly when and how to invest, and finally, we'll navigate those massive milestones, cars and homes.
Okay, step 1. Finding your financial baseline by calculating your net worth and cash flow. Look, we have to start with total honesty here. If you don't know exactly where you stand today, you absolutely cannot map out where you're going. To find that baseline, there are 3 numbers that need to live rent-free in your head. And notice something here. We're looking at your income and your expenses on a yearly basis. Why yearly? Well, because a yearly snapshot catches all those sneaky, irregular spending habits. You know, the surprise bills, the annual subscriptions that completely slip through the cracks if you're only looking month to month. Subtract your expenses from your income and you get your income surplus. That surplus is everything. It's literally the vital gap that buys your future financial freedom.
Moving on to step 2, which is all about strategies for conquering debt. Let's call this the cleanup phase. Think of this as patching the cracks in your foundation before we start building upwards. We have to eliminate toxic debt. Now, when you're confronting multiple debts, you really need a game plan. You've got the debt avalanche, which means paying off the highest interest rate first. Mathematically, it's the most efficient and saves you the most cash. But then you have the debt snowball, which targets the smallest debt amount first. So which one's actually better? Well, it depends entirely on how your brain works. Choose the avalanche for the cold, hard math, but go with the snowball if you need those quick psychological wins to keep your momentum going. Either way, picking one is infinitely better than doing nothing.
All right, part 3, setting goals and budgets. This is the true blueprint for your future. If your goals are your final destination, your budget is basically the dashboard in your car helping you get there safely, and your goals dictate your strategy entirely. Need money in the next 5 years for an emergency fund or a quick holiday? Keep it in safe cash. Seriously, don't risk it. For medium-term goals, like maybe a house deposit in the next 5 to 15 years, you'll want to mix things up. But for those long-term goals, 15 years and beyond, like retirement, your money absolutely needs to be working for you in the stock market. Why? Well, history shows us that over the last century, in literally any 20-year stretch, the S&P 500 has never lost money. It's your ultimate long-term wealth engine.
To fund all those timelines without making yourself miserable and feeling totally deprived, try using the 50-30-20 budgeting rule. It's a fantastic way to visually partition your monthly take-home pay. 50% goes to your fundamental needs, things like rent and groceries. 30% is for fun spending. And yes, you absolutely need to enjoy your life right now. The final 20%, that goes to the future you. That's your savings, your investments, and knock it out any debt. It's a flexible benchmark, but it does an incredible job of keeping you grounded.
Now for part 4, when and how to invest. Let's fire up that growth engine.
Now that the budget is dialed in, it's time to turn those savings into an automated wealth-building machine. Have you ever thought about how traditional banks actually operate? They take your money, they pay you maybe a tiny 1% interest, and then they immediately turn around and lend your exact same money to someone else at 6%. That 5% difference is called their net interest margin, and it is pure profit for them. Honestly, you're just handing banks free money if you aren't proactively moving your cash. Do yourself a favor and look into high-yield accounts on independent platforms that are actually paying 3 or 4%. Keep that margin for yourself. But hold on, when exactly should you start investing? Because you really shouldn't just blindly throw money into the market. You need to follow this exact sequence to make sure your financial house is stormproof. Step 1, save exactly 1 month of living expenses just to give yourself some immediate breathing room. Step 2, aggressively crush any debt with an interest rate over 8%. It's almost impossible for standard investments to consistently out-earn that kind of draining interest rate. And then step 3, once that high interest debt is out of the picture, you can start building your full 3 to 6 month emergency fund while simultaneously investing.
The crucial point here is the staggering, almost unbelievable weight of compound interest. Let's say you invest $100,000 and just leave it completely alone for 20 years at a historical 10% market return. It turns into nearly $700,000, actually $670,000 to be exact, and that's without you lifting a single finger. That right there is the absolute magic of giving your money the time and space to just grow. That said, your investment strategy shouldn't stay exactly the same forever. When you're younger, you want to focus heavily on equities, stocks for wealth growth. But as you get older, you gradually shift over to bonds for wealth preservation. Here's a brilliant little trick for this. Take your age, round it up to the nearest 5, and subtract 10. So if you're a 32-year-old, you round up to 35. Subtract 10. That leaves you with 25. That means 25% of your portfolio should be parked in stable bonds and the remaining 75% in growth equities. It's a super simple rule of thumb to dynamically balance your risk as you go through life.
Finally, Part 5. Navigating cars and homes, the really big milestones.
We have to navigate these massive financial purchases very carefully. They act as the roof of our financial pyramid, but man, they can easily turn into wealth killers if you mismanage them. Let's start with the wealth drainers sitting right in your driveway. Car dealerships are always trying to push you into a standard 60-month loan with zero down, which dramatically inflates your total cost with hidden interest. Instead, you got to use the 24-10 rule. The 20 means putting 20% down. The 4 means keeping the loan term to no more than 4 years, or 48 months. And the 10 means your total car expenses shouldn't exceed 10% of your monthly income. Literally, just shifting to the 24-10 rule bypasses thousands of dollars in hidden interest. It's a total game changer.
Now, what about buying a house? Before you jump headfirst into the highly emotional rent versus buy debate, you've got to strip away the romanticism. Look at these massive, unrecoverable sunk costs. Things like property taxes, legal fees, bank evaluation fees. None of that money ever comes back to you. On top of that, you need to budget 1% of your home's total value every single year just for maintenance. Renters aren't paying for a new roof or a broken water heater. If you're going to buy, you absolutely must factor these massive hidden costs into your break-even timeline.
Which brings us to the ultimate opportunity cost. I want to leave you with this final provocative thought. In a modern economy where stock market returns can, and frequently do, outpace property appreciation, what strategy actually builds more wealth? Does the psychological comfort of owning the physical walls around you truly outweigh the massive opportunity cost of investing that huge down payment, all while renting and maintaining ultimate flexibility? Think about it. It might just be the most important financial question you'll ever ask yourself. Thanks so much for joining me on this explainer. Now, get out there and start building your roadmap.